Welcome to ATS. In case you didn't know, we are officially on the hunt for the holy grail of automated trading strategies. And today, we're going back to the beginning.
We are. We're revisiting the one that started it all, but with a major upgrade.
We're talking strategy number 1 enhanced. Capital efficiency meets persistent filtering.
It's a return to our roots, yeah. But we're applying a much more sophisticated lens to how we view risk and reward.
Now, we are talking about aggressive strategies here. So, quick disclaimer, this is educational content only. Past performance doesn't guarantee future results. Trading involves substantial risk.
A very substantial risk of loss.
Exactly. So never trade with money you can't afford to lose. But, understanding that risk is precisely why we need to talk about this idea of capital efficiency.
Right, because most traders, they look at a P&L, they see green, and they think, I'm winning, but they never ask how long they had to stand in the fire to get that green.
Okay, hold on. Capital efficiency sounds a little, like something a banker made up to sound smart. What does it actually mean for a trader, managing their own account?
It's simple. It's profit per unit of time. Your money is at risk.
Okay.
Think of the taxi driver analogy. If you're a cabbie, your goal isn't to just drive more miles. That just wears out the car.
Right, it's to make more money.
Exactly. The goal is to know which neighborhoods have the best fares at specific times. You want to make the most money per hour behind the wheel. It's about winning fast and then getting out.
I like that. Win fast, get out. So let's apply this to strategy 1. This was our first momentum strategy. I think it used a linear regression crossing a VWMA, right?
That's it. Simple logic. The linear regression tells you the direction the train is moving, and the VWMA, the volume-weighted moving average, that tells you the heaviness of the price.
So when they cross,
It signals momentum is shifting. But the raw version of this strategy, it wasn't exactly a smooth ride, was it?
No, it was rough.
It had an edge, it made money over time, but the equity curve looked like a heart attack monitor. It was just bleeding profit in these predictable ways, giving back gains when the market structure just wasn't right for the setup.
So the fix seems obvious then. If the strategy loses money on Fridays, you just turn it off on Fridays. Problem solved.
You would think so. But that is actually the biggest trap in algorithmic trading.
How is that a trap? If the backtest shows I make money on Tuesdays and lose on Fridays, why wouldn't I just turn off Fridays? That feels like common sense.
It feels like common sense, but it leads you straight into what we call optimization hell. Unless there's a real structural reason for that Friday effect, it's probably just random noise.
Just a coincidence in the data.
Exactly. A non-persistent pattern. We only care about persistent patterns, things rooted in actual market structure, like time of day.
Because the people and the institutions trading at 9:30 a.m. are fundamentally different from the ones trading at 2 bar out in the morning.
That is a structural, persistent difference, 100%.
Yeah.
So for the enhanced version, we built a filter hierarchy. We prioritize time of day, but the real heavy lifter here is the HMM regime detection.
Okay, HMM stands for Hidden Markov Model. That sounds incredibly academic. How does that actually help a trader avoid getting crushed?
Think of the HMM as a weather forecaster for the market. It doesn't care if it rained yesterday. It cares about the barometric pressure right now to predict if a storm is coming.
So it looks at the current state?
It analyzes the current volatility and tells the strategy, hey, it's raining, put on your raincoat, or it's sunny, you can be more aggressive. The strategy adapts in real time.
So instead of just guessing, it adapts.
Yeah.
Okay, let's look at the scoreboard. We ran this on 35-minute bars, 1 year, single NQ contract. What did this enhanced treatment actually do to the bottom line?
The difference is, well, it's night and day. We hit a net profit of $61,660 with a profit factor of 1.59. But the number that really matters, the capital efficiency metric, is the average profit per trade, $422.
Okay, $422 per trade is solid. But I'm guessing you're trading less often because of all these filters.
We are, and that's the whole point. We're not grinding for pennies 24/7. We are sniping the highest probability moments. The raw strategy might have traded more, but it just kept giving the money back. This version keeps the cash.
And this is really just the foundation for a much bigger project.
Oh yeah, strategy 1 is just the first. We're rolling this enhanced treatment out to over 100 strategies in our library over the next 6 months.
That's a massive undertaking.
It is. But if we can increase capital efficiency across the board, moving from pure optimization to structural filtering, it changes the whole game for automated trading.
So does this resonate with you listening? Are you stuck in that loop of, optimizing out Fridays only to get crushed on a Tuesday? Let us know in the comments.
Just remember, if your strategy relies on a pattern that no one can explain the why behind, you aren't trading. You're just gambling on a ghost.
Follow the hunt. We're ATS. Follow the black squirrel. And we're just getting started.